All right. Good afternoon, everybody. This is Event Trader. It is December 21st, 2023, and we are about to kick off the final sentiment and flow show of 2023, which of course means that we will be bringing in none other than chart trader Brett Manning. Brett, how are you doing today?
I'm doing pretty good, Gavin. How are you doing?
Doing good. Just getting ready for the holidays, watching the market action going on here. I'd love to get your thoughts real quick on some of the activity that we've been seeing the past couple of days, and if anything's kind of jumping out to you.
Yesterday for about 20 minutes there was something interesting happening. And otherwise it's interesting. The whole rest of it is interesting. Just when you're talking about intraday trading setups for me, I've got a long book on the investment side in this market, and it's really great what's been going on. But as far as intraday setups, you need a little bit of some kind of more dynamic market stuff. So when we've got just a choppy, grindy movement higher every single day, in relatively narrow ranges, occasionally a little pop, for basically day after day after day after day for a month and a half. Like there's not a lot to do in my book for intraday setups, but yesterday you caught something, and I want to see it. I want to see it make that first volatility expansion, and then I want to see the reaction to the volatility expansion, and then I want to gauge whether or not there's more going on. Right now, it looks like there's not more going on. More going on.
Yeah.
We're right back inside of this really kind of narrow, choppy feel where it's a quiet tape, it's a thin tape. Anything where you take out a level is immediately rejected back up into the range. Anything where you pop above a level, it's immediately rejected back into the range, and it's a lot of chop. So, and which
Yeah,
is, it's not surprising. A couple days till
not
Christmas.
not surprising. And technically tomorrow kicks off the Santa Claus rally period, right? Going from there to T+2 into 2024,
Yep.
which brings us to January 3rd. So, I guess in terms of the markets, what do you have any thoughts for risks that we could be looking at? Is there anything that you'll kind of be just checking out over the next week or so?
Well, you've always got, like, when you get things stacked up to the place where we've gotten them, where there's a lot of money that's late, and over levered, participating in a momentum game, then you're going to get these sudden forest fires like we had yesterday. And that's all it was. It's just like you want to stack so many dried leaves into the forest floor. Eventually there's going to be a spark, and you're going to burn it all up. And then it's right back to business as usual, because it's not hitting the trees. It's not real. It's this smaller money positioning. It's this higher gamble positioning. It's this narrower stop positioning. It's more leverage with tighter risk tolerance and no real bids immediately underneath it, and you're going to get these controlled burns. And when you have a really high momentum rally, you're going to get those situations where something breaks a little bit. You put it as a trapdoor yesterday. It's exactly the way I'd put it. Otherwise I'd put it as a banana peel. It just is something to slip on, and it just kind of, there's a feedback loop, a cascade, but it's not a change in the mode of the market. It's just exhausting all the built up dried leaves in with a match over the course of half an hour. And we got that. And it doesn't really change what's happening in any other frame of reference. And I think it's actually healthy for the market to do that, because if those dried leaves can build up and build up and build up and build up and build up, it can eventually, if you don't do any controlled burns, you burn down the whole forest. So you need moments like that to reset and rebalance, and kind of get too much. When there's too much momentum leverage in there's too much late money, there's too much fast money, there's too many people piled in looking for the same thing. Like, you've got to remind people they've got to get stung a little bit, and it kind of keeps the sort of order of the trend in place. But other than that, I don't see a lot that's changing the picture that we've been looking at. And for a little background, what we've been looking at is if you've been listening to the Sentiment of Flow shows, Gavin and I have been bullish pretty much the most of the year. But we really turned super bullish in early October for a follow through rally. And there were a couple different data points that really stood out. And Gavin probably characterizes it differently than I do. But I think one of the things we centered on was we got to that sort of magic 1.2 number on the CBOE put call ratio for the 10-day moving average. That, we went over the historical record for this. It's basically, this is never at the beginning of a bearish trend. You're never going to get that at the beginning of a bearish trend. And like there's a long history. You can look at every instance. You're somewhere near an important low when you get 1.2 on the 10-day MA of the CBOE put call ratio. So we hit that in early October. We had 4-year highs in hedge fund short interest at the same time. And all this is happening right in front of the seasonally strongest period of the calendar year,
Right,
right?
and and let's not forget also during, the, end period for mutual funds too, where they had a lot of tax loss selling going in to that
Sure.
period. I mean, it was just
Well,
a
that helps the seasonality take
sure.
place.
Yeah,
I
but
mean,
yeah,
that's part of the
right.
narrative of why when you
It's
get
that
past
it's that good
Halloween,
fall house cleaning, right?
yeah, when and you're preparing for year-end stuff and you get past Halloween and it's a different market in most years, especially when you're not caught up in some kind of, you know, like if it's 2007, okay, it's different, right? You've got a secular structural problem that's being worked out of the market. When it's 2015, it's different. You've got one side of on an industrial basis, on a fundamental basis, completely blowing up. Um, right now, that's none of those things are the case, and really the opposite is the case. We've already done this big interest rate rise, and now we're starting to peel back the other way. It's like, and we'll talk about this a little bit more later, but what you're looking at right now, there's two frames of reference here. One frame of reference is what you're looking at here is, so what did we say in late 2021, early 2022 in these shows? What we said is what you're dealing with right now is the end of the Fed put. The inflationary situation is removing the Fed put and the dividend put because interest rates are rising. So you've got this two-pronged thing that's going to remove the supports from underneath the market. And now we're on the other side of that coin. What we're looking at right now is the reinstatement of the Fed put, right? If things get hairy, the Fed's going to cut. Like this is back now, and it's better than ever in a long time. We haven't had 5% rates on the policy side. That's a lot of ammunition for the Fed. And you can't really, the importance of that is huge. And the other side of this is we're at the same point. We're just kind of like, this is 2024 coming up. This is the beginning of probably the most transformative period of technological revolution that we've ever seen in the history of the world. And this is another thing that we've talked about. There's a sense in which this is like the 1990s or the 1920s. Like this is, we're headed into quantum computing, fusion energy, and artificial intelligence, and it's all real. And it's like there's the consequence of that is there's a certain percentage of the equities market that's never going to be sold. Never going to be sold. There's a part of that people are not going to liquidate. They're just going to get down to a certain core portfolio, but there's no way they're going to bob out because we know the sort of shifts that are coming over the next 5 to 10 years, and it's just a secular trend. So that puts a foundational layer in there. So when we get these shorter term sentiment indicators turning super bearish and super short, and all of these, looking out the next year, we've got these really rocky waters we're going to have to face. People are looking past that, at least with a percentage of their holdings. So this kind of puts a baseline foundation in. And those two factors together, return of the Fed put and that foundation holding strong and everybody being short and overhedged, kind of all fed together in October and really set up something that we talked about as, this market is there's a lot of upside risk here, and we're seeing it play out right now.
Right, and we'll start getting into the slides here, so we can get through those. But just taking a look, Brett, at the current market characteristics that are going on right now to start off the conversation for this week's or for this month's show. Markets on pace for a ninth straight week of gains. It all plays in that seasonality and that bubbling up that you were just talking about with positioning, something that we had been taking a look at. And we're going to look at some of the new positioning data that we've gotten here to see what kind of continuation we could get. Rates, they continue to decline, a little bit of a bounce here following that pretty strong tips auction that went on today, showing that some people certainly are concerned about inflation. We're going to also be keeping an eye out on the Red Sea developments there. We'll talk a little bit about geopolitics later on in the show. Economic data is showing some signs of cracking. However, jobs have definitely been a notable exception, right? We initial claims this morning being the latest that really didn't show any sort of drop off or any sort of big round of layoffs that are happening. But we are
You know,
keeping close attention. What's up?
well, I think the Atlanta Fed GDP now for Q4 is still up close to 3%.
It is. It is. Now, there were comments from Paychex, PAYX, on their
Mhm.
earnings call talking about a little bit of weakness that they were starting to see. Cintas as well, who does a lot of uniforms for employees. So they got a pretty good pulse on the
Mhm.
jobs economy, and they did have a little bit of forward-looking concern out there. So but for now, not really seeing it. The other thing that I thought was interesting, Brett, 2023 stocks and bonds performance very similar to four other time frames: 1999, 2009, 13, and 21. All time frames where people thought that that was the end of the rallies. But the US PMIs, they rebounded rapidly from troughs each one of those years, and we've certainly seen that in the PMI data over the last few months. So it's another thing to kind of keep in mind. I thought that was interesting.
It's kind of
um,
like the old adage of economists that predicted 7 of the last 4 recessions.
Right, exactly, exactly. And I mean, what are we going on about month 24 of the recession coming from some of the bigger shops out there?
Yeah.
So, it's something we're watching. Expectations for a soft landing is certainly prevalent here, and credit so far remains benign. So, there hasn't been anything really to unseat things that we're looking at in terms of the market characteristics. So let's take a look at some of the data that we've gotten here. Starting off, Brett, with the AAII data. We got that this morning. Bull sentiment came in at 52.9. Neutrals down at 26.2, and the Bears down at 20.9. A few stats on this, Brett, and then we'll get your thought. This is the first back-to-back 50 plus readings since April 2021.
Yeah.
I thought that was, I mean, I was expecting to see some earlier this year, but no, just first time since 2021. Um, here's obviously well above historical averages, and I thought it was interesting. The 8-week moving average, it's the highest since September 7th. But that does also include that clunker from November 2nd of 24.3%. So, bit of an outlier, right? So that thing's going to skyrocket. And then the bull bear spread, Brett, at 32, highest since April 22nd, 2021. So, what's your take on some of the data that we're getting out there on the sentiment front this morning?
Well, so one of the things I'll caution again, and I've cautioned before with the AAII data, there's a lot of that. So this is a great contrarian indicator in when a bear trend is getting too when people are getting too bearish about a downward move, and it's not nearly as good when people are getting too bullish about an upward move. There's if you just look back at the charts, you'll see a lot of instances where, so like for instance, the bull ratio, the right now the bull ratio, which is the bulls divided by the bulls plus bears. So you basically take the neutrals out, and you look at the percentage of bulls and bears that are bulls. That ratio hit today the highest point that it's hit since I think it's April 7th, and on April 7th, the S&P was in the middle of, and I think it's probably the time that you were talking about as well with the two straight, April 2021. Isn't that what you said?
April 2021, yes.
Yeah. So April 2021 was followed by another 6 straight months of straight up rallying in the market.
Right.
It was
Yeah, I
not
mean,
a time to short the market.
yeah,
So
we closed out just for reference. We closed out April at 41.74. We would eventually hit 47.99 in
yeah, I mean,
December of that year. So
significant rally was just getting started when we hit that number. It was midway through, really. I mean, it was kind of middle of the trend. People are bullish. It happens that way a lot of times. So there are times when it works as a contrarian short signal, but much better if you look at the bottom end of those tails for the AAII. It really, like when everybody's bearish and it festers in a bearish sense, you get 6 weeks of some abnormal readings, and nobody's exposed, and that's when you get a good buy signal from that indicator. So it's not so much a good shorting signal. So it's tough to take this as a meaningful input in terms of what you how you're going to act as a market participant. Yes, it does say there's a lot of people bullish right now. There is, and
Yeah.
they can just continue to be that way for a while.
And it also adds into what we've talked about in terms of people just kind of talking their book, where a lot of people that probably weren't bullish are throwing in the towel now and being like, "Oh, I've been part of this rally. I've been invested in different areas of it."
Yeah,
So
well, it also
you do
speaks to
see
the
a lot of that.
asymmetry. It speaks to the asymmetry of the equities market. Like, there's not a lot of shorting. It's not like the forex market or the commodities markets. Like, you get 90% long only, and they're either going to put more money in or not. But if it was a more balanced market, this would probably be a more balanced indicator.
Yeah. So we will continue to track this going forward, of course. But bottom line for the AAII is that we are seeing some bullish extremes, but that doesn't mean that that's going to necessarily mean
Right.
the end to this rally.
You no longer
So
have a contrarian buy. We can say that.
yeah,
You no
yeah,
longer have a contrarian buy.
yeah,
That's the thing. As you can
it's
say.
it's not the screaming buy in terms of people on the sidelines
Yeah.
and stuff,
Right.
so something for us to continue to check. But certainly that data unequivocally has been bullish the last couple of weeks here.
Right.
All right. Breaking into some of the primary characteristics or some of the most notable interests of the Bank of America Fund Manager Survey, which we use as a good basis for some of the sentiment and flow readings. Brett, most upbeat since January 2022. Goldilocks 2024 outlook is the baseline scenario right now,
And I'll just point
according
out
to
January 2022 was the high before the bear market.
correct. Investors cut their cash to 4.5 from 4.7%. This is a 2-year low on that measure for them,
But not a low.
but
Like
not a low.
it's
Correct.
not a low data point.
Correct.
3.9 would be a low data point.
Right, and we do have a chart of that coming up. We enter 2024 most bearish on commodities since March 2009, which obviously 2009 was the bottom of the great financial crisis. So people are shunning commodities, which just kind of goes into that global recession is coming outlook that a lot of people seem to have. Certainly prevalent in the commodity activity that we're seeing out there. 50% expect weaker global growth. 91% say the Fed rate hike is over. Record high expectations for lower yields. That naturally matches up. Highest stock overweight since February of 2022. Again, as Brett said, January 2022 did mark a high in that particular period. Highest bond overweight in 15 years, Brett. So
That's interesting.
yeah, definitely some, especially when you see where yields are right now. Can that continue to grow? So moving along, we're going to kind of talk about some of
Let me add
these.
one thing here. Let me add one thing.
Yes,
Just when there is an asymmetry here as well to recognize, this is Wall Street big money managers. This is the interest of Wall Street and Wall Street's success. When they're overweight things, there's a whole machine. It's like the house in a casino, and you can bet against the house, but you don't win quick. And right now, this is where those bets are. People with careers on the line who are managing the lion's share of capital in this economy on an investment basis are positioned this way. They are long stocks and they're looking for lower yields. And that is the zeitgeist and that is the positioning. And you can chalk it up. You can call me tinfoil hat guy, whatever you want, but you're going to see information come from the ecosystem that surrounds that positioning that is in favor of that positioning for a while.
yeah, that's always the case, right? I mean, you talk about people talking their book, but it seems like in these scenarios they're talking against their book just to boost their book up higher, right?
I guess, but I'm just saying, this is now where they're positioned, and so every piece of information you're going to get from the world is going to be in some way
A false
favorable
flag.
to that positioning in my
Right.
experience.
Yeah. So, well, taking a look at the fund manager survey, we talked about the bullishness in the AAII, which is the individual investors. So this you can see not as extreme, and we're talking about the potential for a little bit of a further pop coming out here, and you can see when it did get to those highs, QE1, BRICS tax cuts in 2018, the blue wave in 2021, and now we're just kind of in the middle of
Yeah,
that period right
it's
now.
not a sell signal.
It's not a sell signal, exactly. So again, what Brett was talking about with the AAII, this is a different survey from the AAII, and it's important to understand the differences on who's kind of involved and who's not in this market, right? So, to Brett's point about them kind of talking their book and looking to get things a little bit more favorable, this is where you might see that playing out, right? When you're looking at who's invested in this market and who's not. And certainly it seems like retail, or the dumb money as they're allegedly called, seems to be outperforming the smart money, right?
Yep,
So,
if you say so.
okay. Equities versus growth sentiment here. This is global growth expectations. They have been improving, but certainly do remain weak. You can see down there the net percentage expecting a stronger economy. It's still in the negative territory. It is off those July lows, and you can see how the S&P has performed against some of those expectations. So S&P certainly leading the way there. So I guess the
But it
question,
usually doesn't.
it usually doesn't, right?
If
So
you look
that's
at this chart, it usually does not. So it's interesting.
right. So that's the point. Which one's going to drag the other one here seems to kind of be the question mark. We've talked a lot about 2023, about the negative sentiment that seems to be prevalent out there. And I think that this is just one more example of that going
Yeah,
on when you see the soft versus hard data.
yeah,
So moving along, commodities, as we were just talking about, they've been
same thing.
shunned.
Yeah,
You can't see a lower and this factors into those growth expectations,
yeah,
right? And this is net percentage overweight commodities minus net percentage overweight bonds. Now, of course, we are at a 15-year high on the bond side, but again, that's more for protection getting into bonds, right? And where it just highlights, if we start seeing econ data turning, particularly in China, that could really set this commodity space on fire. So we'll talk about that when we look at it 2024. Energy also shunned, of course, kind of falling into that same wayside, right? Where you're looking at growth concerns going on. So, Brett, when you see the energy positioning, the commodity positioning, and the sentiment around growth, what what is going through your mind in terms of opportunities?
yeah. This is the most difficult dynamic for me to fully understand right now that we're seeing. I can admit that openly and honestly. I don't like you're not seeing the underlying fundamentals or the policy track for oil and its derivatives um, to be showing any big warning signs, and yet people are selling it like crazy. And yeah, I find it very fascinating. I'm not sure, and usually when I'm not sure, it's just because there's something I don't understand, and I eventually figured out, and the market was right. And it's just a question of like, when am I going to slap my forehead?
Yeah. Is there any activity that you're kind of planning going into 2024 around any of this space?
Well, I mean, right now, so I feel lost where oil is concerned. So I don't know. I mean, I
Yeah.
know what I believe on a larger time frame basis, and if I start to see some signs that's confirming that basic idea that there's this larger time frame that we're undersupplied on a structural basis because we have underinvested for a decade and a half in capacity expansion, then that's going to play to something where I feel strong about, and I feel like I've anticipated this, and there's a period in the latter half of this decade where we could see enormous, growth in energy prices. Um, and maybe there's a factor that I just don't know about that's playing into this that insiders know about because it's a very insider market.
Yeah. You got a Jack in the Box back there?
It's a cuckoo clock. It's an awesome cuckoo
Uh,
clock made in Bavaria
nice, nice.
with the
Yeah,
little, the whole, I mean, the whole, this awesome
interesting.
little cuckoo comes out and people
Yeah, no,
dance.
I got one from the Black Forest Company
Oh
myself
yeah, that's pretty
at
sweet.
a Chris Kindle Mart, which I do miss
I
about Chicago.
I got it and put it in my office, so my kids will be mesmerized with it, and they are mesmerized.
Nice. All right. Well, moving along here. Next up, Brett, we got the banks rebounding here. Investors overweight banks for the first time since February 2023, which is, of course, right before the Silicon Valley Bank
Yeah, right.
disruption. That was another area on the Summit
Before
and
the
Flow show
stupidest
where,
banking crisis ever.
yeah, where we hit on that one, talking about some of the issues that was facing it and how easily it could be
Yes.
called over, which it was. So we are getting people back to overweight financials,
Do you
though.
think?
So
Cap? Do you think that it was like a little bit like there was sort of like a Wall Street wanted so badly to be bearish during this period, and that they just saw this as a device that would help, remind people of the horrors of 2008 and
yeah,
like,
I think it was more than just the response from 2008 still lingering, where people kind of glossed over that, and then all of a sudden, the issue spiraled out of control, and people were like, how did we not see that? I think that there's still such a shock factor from that crisis that
yeah, there's a PTSD, but
yeah,
still,
I mean that's the reason why these major crises tend to be generational, right? Because there's still enough people in the markets that clearly remember the great financial crisis and were immediately going in. I mean, once you start seeing Noriel Rubini making the rounds and stuff like that, that the
yeah, but,
that the
but
panic
you
meter's
saw
at
the
a high.
positioning. You saw the positioning though. I mean,
Yeah,
some firms had an interest in seeing the market go to 3,000.
right,
Like
exactly.
they wanted that because that played into their strategic underpinnings. And
Yeah.
then this came along and it seemed just like it was so obvious to look at it like, dude, this is not what you're saying it is. This is not at all that. And it just kind of escalated in narrative terms of like, oh my God, all the banks are gonna fold.
Plus, with all the amount of liquidity in the system too, it's far different from that aspect as well. So,
Yeah.
with regards to the banks, you got any thoughts on them? Do you have any interest in them?
Yeah. I mean, I think I think you're gonna see this overshoot on the other side with the regionals probably.
Yeah, so you
They're
see
gonna
them,
get yeah, I would imagine this rally is gonna get to an absurd place. Like,
yeah,
people are not positioned for it, and it's gonna pass all the way through all those levels until they become, you know, momentum favorites and overvalued and
right. So, okay, well, they are now overweight. Taking a look at some of the other aspects of it, the margin outlook. This is going to be one of the big stories we'll talk about here, but the profit outlook is improving as net percentage say global profits will uh, be better from the current period as ISM manufacturing new orders, and just taking a look from the difference in the ISM manufacturing new orders and inventories. Now, we did have some weak data this morning from the Philly Fed, so on the new orders. So I'm kind of curious to see how that plays in. But and the prices paid that did have a little bit of a jump going on here. But these margins, that's going to be a big story in 2024. So I'm just kind of curious when you look at this chart and look at the ISM, what's some of the things that you're going to be looking for moving forward in the next couple of months?
well, I mean, I'll just say that the market right now overall is telling us that this is going to improve.
Yeah, I
I
mean
just look at
that's
the chart of the S&P to answer this question.
just going off from the basis of it, right? I mean, just that bounce, that chart that's all on the upswing.
Yeah. I mean, this is the prime dead center zone. It's like this is gonna become but you're gonna see more profitability.
Right, which is huge because one of the concerns that a lot of people have is what's going to happen with the inflation deflationary impact on margins moving forward. So we'll get into that a little bit, but it is interesting to see this margin outlook improving going forward here, which doesn't really necessarily match up with some of the concerns that I've seen around earnings moving forward. And when you're looking at it from a manufacturing standpoint, obviously commodities and energy prices should benefit from this, right? We just talked
But if
about
you have
the
lower commodity prices, lower interest rates, and higher productivity, what are you going to see?
if we get what now?
Lower commodity prices, lower interest rates, and higher productivity.
Greater margins.
Yes.
So
We're seeing all of those trends over the last month and a half, and this
right,
is
with input prices, obviously the PPIs have certainly been in the deflationary spiral here. So a lot of that has to do with whether or not China's going to come back online, right?
there could be problems. Yes,
So
idiosyncratic problems could exist.
and possibly too with shipping, right? Global trade when you start seeing some of the things going out in the Red Sea.
Yeah, probably priced in, but yeah.
Yeah. All right. So moving forward, tail risks here. Number one, global recession hard landing. And the reason I know you hate this slide, but the reason why I threw it in was because it makes zero sense when you look at everybody expecting a soft landing. Well,
Because
maybe
they
I get
don't know
from
what
the
else to
standpoint.
answer, Gav. It's a multiple choice question.
Yeah.
Like
Right.
you got what if you had to pick one of these choices? It doesn't mean you believe that's going to actually happen, but somebody tells you have to pick one of these.
Yeah.
That's why I hate this question. Like it
Interesting to
doesn't. It
see the
in no
U.S.
way
election.
includes any conviction.
Interesting to see the U.S. election popping on here right now as
Yeah,
we
I'll
do
put
get
that
into
as
election year. What you'd put that as number one?
yeah.
Yeah, yeah,
I mean,
probably
we're
at
gonna
this
have civil
juncture.
war by then, so yeah.
Yeah. So hopefully not, but I'll be curious to see how this 7% progresses as we get deeper into 2024 with some of
But
these
look
fund
at these
managers that are
choices. So imagine, I just want you to imagine somebody seeing the multiple choice, A, B, C, D, E, whatever, looking at these choices. I think most of the people answering this question right now, given what we just saw in overweighting, like it's gone from underweight to overweight. All the people answering these questions have just bought in and they're answering this question and they're probably mulling a lot over if any of these things seem plausible. And they've got to pick one. And so they just pick one. Okay, I guess that we've all been taking a test where we're like, none of these things seem like the right answer, but I got to pick
right.
one. And I
Yeah.
think that's where we are in the market. Is that so when you see this emerge as like 32% think global recession is a big issue, like it's not what it means. It's a
Right.
bunch of people who just had to take a default choice that they think is less improbable than the other choices.
Yeah. No, that makes sense. But I did think it was interesting just kind of seeing this when everybody seems to be on
Yeah.
the growth trajectory and everything. So
It's a
uh
terrible question. They should change it to being some way that people can express both their pick and their conviction level in it, and then kind of find some, uh, 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 aggregated data point that expresses both what you see and how likely you think that actually is.
yeah. Well, we'll continue to watch this as it trickles down deeper into 2024, but it should be interesting to see how it unfolds. Bond yield expectations 62% expect bond yields to fall. Net percentage saying recession likely versus percentage wanting companies to improve balance sheets. So you could just see this breakout that we have going on here in the yield expectations. So really hitting extremes on that part, right, Brett?
Yeah, right, sure.
So, moving along here, services, X food, energy, and shelter, just kind of changing pace here and taking a look at some of the
Super
data
core
that's out there. This is the super core, the sticky data, and you can see it's just kind of slipping lower, going in the Fed's
gliding down.
direction.
Look
So,
at that thing go.
what's that?
I said gliding down. Look at that thing go.
Yeah, yeah. So, I mean, this is all falling into place for the Fed on that deflation potential. So, again, this is why you're seeing that pop in yields heading lower here. As it certainly looks like the Fed is getting the job done. This is the lowest for the data point since September
You know what it
2021.
is? It's team transitory strikes back.
Everybody that argued that all the inflation was transitory, they
Oh,
were right. They
yeah,
were
you
right.
heard in
It
the
was
last
just
meeting,
over a
right?
longer
That was it.
period of time.
What I heard was Powell saying you know, he's bringing back team transitory. Like the last meeting, he finally felt safe, even in a safe place to do that. Like he's believed it all along. He never gave it up. He just knew he couldn't say it anymore. And then he
Right,
started, like the
which
last meeting, he was like, "See, I told you it was transitory."
right, which would put him in the same category for if we get a recession in 4 months, the people for 2 years that have been calling for it a recession are gonna act like they were right.
Well, yeah, but it would also put him in the same category of like, if you just took my advice that it was transitory, we wouldn't have a recession now.
Well, if you took the advice that it was transitory, we would have never raised rates, right? And
Yeah, it's a big question, right? I mean, but still, the communication was
I
we're
mean,
going to
I,
have.
I mean, I
He
suppose
clearly
then
got
you
cowed.
well, I mean, you're turning that into a discussion about what's the definition of transitory, I
Yeah,
suppose,
right.
at that point.
Sure,
I mean,
absolutely.
transitory could be if we want to go 5 to 10 years. I could be
Sure,
right on a
sure. You
lot of
want to get
things being
technical about it.
transitory.
Yep. No, no,
So,
there's no doubt you can. There's all these different ways to parse this, but I just felt his energy in the last meeting was like there was a "see, I told you so" coming underneath the surface of it to me, which was like he. I mean, he went off on like several.
I didn't get that sense from him because I mean,
Okay,
just two
well,
weeks.
let me give it to you. He went on
Yeah,
several little spiels of like, this is not the kind of inflation we saw before in the 70s and 80s. This is different. This has to do with the reopening of the pandemic and the imbalance between supply and demand that was due to idiosyncratic issues. He said that like 4 times. And he hasn't said that stuff for 2 years. But that's all he said 2 years ago, over and over and over every meeting. And he got cowed into we need to say this is monetaristic. We need to say that this is an issue that has to do with too much liquidity and too much demand, and we need to not let people think that this is going to end without us shutting it down. And maybe that's right both ways. Maybe it's right to do that both ways. But I just felt from him a sense of like, bringing back that narrative in full splendor now, which to me is kind of like declaring victory.
yeah. I didn't quite get that message myself.
You to pick up the
From
vibe.
no, I mean, I think it was more that the actions that they've taken are are paying dividends right now, and inflation is trending in the right direction. But I didn't
But
get
he
the
did
sense
say the
that he.
causality of it was different from what we saw in the 70s and 80s, and he got a whole little spiel on that.
Yeah, but I mean, everybody knew that. I don't think that he
Did they?
introduced any new concept from that.
Did they?
I mean, everybody was looking at the 70s because that's the last time we had inflation. So, I mean, you're kind of limited with what periods you could look back at and go through. I mean, I think everybody would agree that the second round of fiscal stimulus probably was unnecessary, and that the ultra low monetary policy for as long as it was also something that needed to be broken at some point.
Well,
So,
I saw him.
and I feel the fact that that we broke that ultra low policy. That I mean, you were just talking about it earlier. Think of how much happier the Fed is right now in the
Oh
current
yeah.
situation, where
Oh
they've
yeah.
got
Come
they got
on.
plenty to cut right now if things start going south, where they
Oh, it's
didn't
meat
have
and
it prior.
potatoes monetary policy now.
So I feel like he feels kind of relieved that
Sure.
the
No
actions
doubt.
that they took so far are playing off, that
No
they're
doubt. Oh yeah.
engineering a soft landing, and that they have room for action. Like they didn't have any room 2 years ago to take any action,
Oh
right?
no.
I mean, you already
It's so
had
much better now.
the balance sheet out. So I think it was more from a perspective of that than thinking that he was right about the transitory. I mean,
No, I still think he's wearing a suddenly walked back out with a shirt and hat that says Team Transitory.
okay, all right. Fair enough. We'll let you go with that.
All right.
Moving on, the Fed balance sheet here also on the decline as they slowly unwind that. We're still waiting for them to announce at some point a general target of where they want. I think the market would love to hear like something in the 5 to 6 billion trillion range, right? So
I'm not sure this chart's relevant.
how so?
I just don't know if it's relevant.
I'd like putting it in just for a liquidity standpoint. I mean, number one, we're still up well over $7 trillion on the Fed's balance sheet. I mean, I think it's very relevant if you're looking at mortgage-backed securities in the housing market, and it's
Uh,
also. I mean, if they were to start selling a lot of these treasuries,
I think we've
and
adjusted to this reality.
do you think if they announced that they're going to pick up the pace of the balance sheet unwind, that interest rates would just take that into consideration without any worries and not
I think
spike?
that would be a day or 2, and then it would just go back to whatever. I
Okay.
think that we've adjusted to the it's like the deficits. Look at the national debt between now and 1950. We just
Right.
adjust. It's all money's just a fiction. Like we just adjust to like, oh, you change the numbers now to this. Okay. And then we at first we freak out and then we just adapt to it. And we've just adapted to this reality at this point.
Yeah. Yeah. So, well, I like keeping track on this more for anything, just to understand how much liquidity is out there in the markets, and just looking from that, there is still a ton. So, again, we'll keep an eye
I mean,
out
I
on.
enjoy the chart, Gav. Don't get me
Yeah.
wrong.
Yeah, I got you. I got you. You just find it useless.
I enjoy finding it useless.
Yeah, there you go. I mean, somebody's got to find it useless, I suppose, right? But bottom line, it is trending in the right direction. All right. This I thought this was interesting because a lot of people are worried about
I think
everyone's
this is
going to be
amazing.
buried
Yeah.
by the debt burdens that are coming forth. This is from Wells Fargo in their 2024 year ahead. This is non-financial corporate interest burdens, and look at that decline going down there when you compare it to like 1990 or the great financial crisis 2007. This has been stair stepping down. Now obviously it's going to look a lot like the interest rate uh the interest rate chart from going back from the 80s through. So
Yes.
that's not a surprise to see it. And obviously there's going to be a lag in this, but when people are raising the red flag about, oh, everyone's going to go and default, remember, people have spent the last 10 years getting in at dirt cheap rates and trying to elongate that cycle for as far out as they could. So we're not seeing this tick up just yet. And interest rate burden is going to be something that's real as we get deeper in, but for now, it's not there.
And the steep decline that we're seeing now in rates, like they can time it again. So
Yeah, yeah. I mean, you
there's
you can be
they
sure you're
want a
going to
little
see.
recession maybe here. Let's get a little minor recession.
Yeah, and if you do, you're going to see probably a record amount of issuance
Yes,
coming
you
out the
are.
door as people start
Roll that.
rolling that out and stuff. I know I'll be jumping on it looking for a house, that's for sure. So
Yeah.
these corporates are definitely keeping a close eye on that. But remember this chart when people start telling you about all the bankruptcies that are
Yeah,
on
right.
tap
Yeah.
for 2024.
Important chart.
Household debt, pretty much the same thing here. I mean, look at household debt compared to 2007, 2008, the great financial crisis. We're certainly on the uptick. There's no doubt about that. You certainly saw it come down when everybody's coffers were flooded with the stimulus money, and that
Yeah.
has crept back up, but we're not at extremes yet for a financial crisis.
In other words, what we're seeing here is that if you have a long period of very low interest rates, it lays a foundation that's going to extend beyond that period.
So, exactly. And this is one of the reasons why we could continue to see an upswing in 2024. All right. Next four slides, Brett. The interesting slides. These are rate cut cycles and kind of the price action. So the thick blue line, this is percentage of fund manager survey investors that were overweight in equities. The green lines, that's Fed cut cycles. The red lines are Fed hike cycles. So you can see what's going on here is you got that price action where every time you get out of the green, you kind of get to the highs and then you just start dipping down and then go back up during the hiking cycle, right? That was in
Yes, but there's very
2006.
different contexts here, right?
There
Like,
is very different context, and I'm not trying to paint it over. I'm
okay,
j- I'm just kind of looking at the ebb and flow of this, and you can kind of see it going through. So right now we are at the end of this Fed rate hike cycle. You can see the Bank of Manager, the fund manager survey actually have a green piece in there for the first part of 2024, and we
Mhm.
are on the push higher. So, and I'm just going to show you all four charts here to get a cumulative. But just remember this chart, and we can swing back, Brett, as you want to
Okay, we
talk
need to
about them.
swing back. Go
Yeah,
ahead.
and here's the average cash level percentage of assets under management first Fed rate hikes, first Fed rate cuts and hikes. And again, you can see whenever the rate hikes are going on, you get a little bit of a drop going down in the cash levels as a percentage of assets under management. Then the other two, this is from NatWest from their year ahead look. This is just kind of taking a look at the recession on average beginning 12 months after the peak in the fund rates, which would, of course, be coming in around next September. And Brett, if you think about it, that lines up perfectly with the seasonality storyline, right? Coming out from the summer of 2008.
Sure.
And then final on this particular slide, easing in monetary policy typically begins before a recession starts. We got a lot of people, of course, pointing out that we're going to be looking at the first rate cut coming around March or April of next year. So I'll go back and remember, I will be posting this to the site, these slides, so people will get a chance to look at it. But Brett, taking a look at these slides, what's your thoughts?
Well, my main thought here is that there's a very different reality when you're in. So I think of the boogeyman, and if the boogeyman is deflation, there's one reality. If the boogeyman is inflation, there's another reality. And this chart right here transitions. The boogeyman is deflation for most of it, and then the boogeyman shifts to inflation. And people act in the opposite manner when that's the case. So you can see, for instance, those big dips in cash. One of them's a dip during the rate cut cycle in 2008, 2009, 2010. Now we see a big dip during the rate hike cycle. And that's because of the shifting boogeyman. If you have to, and you see it above the center line during the hiking cycle from 2016 to 2019, again, that's because look, when you're in a deflationary cycle, when the boogeyman is deflation, then raising rates means finally we're starting to get out of this morass. We're starting to get out of this swamp. And now, rate hikes mean a very different thing because we've got, we went up to 9% inflation on CPI. Like there's a very different reality now. And rate cuts mean we're starting to get out of the slog. So they mean the opposite thing. So I think this chart's a little misleading in that sense in terms of trying to pick up what the standard pattern is.
All right. Well, it's something that we'll be looking out at. But I, one of the things I'm just seeing, Brett, is just a lot that, everyone's kind of looking for a slower growth in the first half of the year. But there are a lot of elements from the current rally that we're seeing that points to the potential for an extension, especially when you're looking at rate cut cycles and some of the sentiment data that we're looking at prior. So we'll continue to watch this again. These charts will be going up, so everyone could take a look at them. And I'm sure it's going to be something that's debated pretty heavily in 2024. Speaking of
Indeed.
2020, you got something to add, Brett?
No, I said indeed.
Indeed, yes. So let's break in, since we got a nice little segue here, into 2024 key themes, Brett. And we obviously some pretty basic ones, but we'll go through these real quick, and then I want you to circle around and give us your thoughts. Fed rate cycle, of course, just talking about that. When are they going to start cutting? Elections, U.S., UK, India, South Korea, Taiwan. I think it's something like 57% of the world's GDP, it might even be higher than that, Brett, is going to have an election next year. So big cycle on that front. Disinflation and the impact on earnings. We were talking about that before. Currently, the U.S. forecast is for 11% year-over-year growth. And Brett and I were talking about the weaker commodities to the higher productivity and how that could help margins and the higher margin outlook. So that's going to be a key theme for next year. Week one, of course, the growth forecasts, they are for pretty weak growth, perhaps even a recession in the first half of the year. Keeping an
Mhm.
eye out on the credit. Brett and I took a look at two of those slides with the non-financial corporate burdens and the household debt that continue to play into favor of this being a benign issue. U.S. versus the rest of the world, and the Fed versus the ECB. Watching those currencies, can China recover? This was supposed to be a big theme in 2023. They've kind of muddled through that year, and without any sort of recovery. And then balance of risk, where we're talking for, again, back to those rate cuts. Is it being cut because of inflation being weaker or recession? And then finally, commodities. Can they recover? So, Brett, taking a look at these big themes, what are the ones that are sticking out to you and that you think are going to be the most interesting in 2024?
So if I pan back and I just think, well, 2024, like where, like the whole, if I summarize the whole thing, I think I really think that I think that we underestimate the importance of the political situation in the United States. So there's that. But I also think, it's at the same time, look, the big headline to me is the Fed put is back. Like that to me is the simplest way to summarize the whole picture. The Fed put has been gone since January 2022, really since December 2021. And the Fed put is now back. And that's a big deal if you look at the history of how risk assets perform. The idea that if there's any trouble, the Fed can cut rates. Like that's been gone, and now it's back.
You're saying just from the aspect that they've jacked everything up 500.
Jack interest rates up with the declining inflation. Like right now, if you see, a banking crisis, you're going to get a rate cut.
Right.
Imagine a year ago, we got a banking crisis and they couldn't even cut rates. Like this is like because you had 6% CPI or something. Like it's back. So right now we've got like they can take steps and they've got a lot of ammo. They can cut rates again and again and again and again and again and again if they need to. We haven't had that situation in a long time.
Since 2007,
And
basically,
it's
right?
powered the last secular bull that just went on and on and on is having that situation. So that's a big factor.
Do you think that they have the ability to still use the balance sheet as
They don't need
as well
to.
as they have?
Meat and potatoes. Balance sheet's what you got to use when you can't use the meat and potatoes policy. Like we don't know. That's pushing on a string. We don't know how well that works, but we know rate cuts work. Like you only have to do that stuff when rates are at zero. We've been in that situation for a long time. Suddenly we've got rates at 5%. They can cut till their eyeballs bleed. They can just keep cutting. Like they've got a big stockpile of ammunition. Now, for the first time,
Can they cut rates if they can't borrow?
they can always cut rates when rates are high, right? I mean,
Well, I mean, let's look at the episode that we saw in September, right, when the Treasury Department came out with their plan to issue a greater amount of treasuries, and everybody was talking about how rates popped up and were running about 100 basis points above where the Fed rate should be running, right? And a lot of that was term premium.
I
And
see. Fine. Right. Okay. But
but
there's
I'm just saying I don't think it's a complete all clear that rate cuts are the only thing that could work here because of that very issue that we saw play out in the later part of 2023.
I think that if you have a growth shock and fears of a growth shock, they're going to cut rates. Do you disagree with that statement?
They are totally going to cut rates. What I'm saying is I don't think the effectiveness of it is so clear cut because of those borrowing
All right.
issues that they saw. I'm just saying. I mean, we've seen a couple of the agencies lowering their outlooks for it. Now,
Okay. If the credibility is shot, the credibility is shot.
is it the cleanest shirt in the laundry? Sure, but I mean,
Especially in a crisis.
you were just talking though about. I mean, but what if that crisis is the election?
Okay.
Right.
We can get to a dystopian view if we want to go there, where,
Well, I'm
there
just
is a
saying I don't
reality
think
I
it's
can
as clear
construct.
cut. I just don't think it's as clear cut. Would you disagree?
I think that under 98% of conceivable scenarios over the next 8 months, where there is some kind of there's a storm in the economy. There's something the Fed can react to in a meat and potatoes, old fashioned way. They're going to, and it's going to work the way that it has in the past. I think that that's where we're at right now. And I think that that's something that but I think that like it's sort of like about believing in that. If people believe that that's true, it has an impact on everything, and it kind of prevents it from happening. There's sort of a time machine issue there, right? Like if people know that that's the case, it impacts the game theory of how everybody behaves. And one of the problems when we're traversing this long period after the global financial crisis where you didn't have the ability to have this sort of meat and potatoes ammunition from a policy standpoint is anytime things went wrong, there's just this end of world thinking, and that's built into even before that happens, where people take different kinds of risks or they have a different risk profile because they understand there's no safety net. And if I think of like trapezists at a circus, like imagine trapezist just kind of swinging on one and just letting go and grabbing the other one versus one doing like triple flips in the middle because there's a safety net down there. People will take more risk when they understand that there's a safety net down there. And I think that if you've got declining inflation and the Fed at above 5%, like that's that safety net. The Fed, the idea that the put is there, whether or not they actually use it or have to use it or can use it, there's that point is sitting there. People are aware of it. They're aware of the fact that for the first time in a long time, there's a genuine systemic central policy safety net underneath risk assets. And it really is the first time in quite a while.
Right. And we're going into this, of course, with bullish sentiment pretty high, and positioning is a little bit more in favor of the bears too. However, there still remains a lot of money on the sidelines, as we are talking about, with that cash standing out there. So that is what we're going into 2024 with, Brett. We'll just kind of do a quick conclusion here.
Well, I
Um,
think just one other thing on this list, I think that China exporting deflation is an important issue as well. It helps to maintain that status quo.
it does, but again, that goes to the point: do we want China to recover from that perspective? Right?
I think
I mean,
you do, but there's still kind of like it was much worse for the United States' own self interest. It was much worse in 2016 and 2015 when that was going on than it is now because we have an
the supply
inflation problem
chain's
now
been
and we had a deflation problem then.
right, and the supply chain's been changed a little bit too, right? Which doesn't put as much reliance on what's going on with China as it has in the past 10 years, I would say.
Probably that's true. We have inoculated ourselves to some extent.
Yeah. So, well, look, so we went through the 2024 themes, Brett. Setting up looks like it should be a relatively quiet week. I'm seeing we're getting a nice little squeeze here. A lot of these Reddit
Mhm.
stocks seem to be driving us late in the day, so we're getting into that period of the trading cycle, getting into the Santa Claus rally officially starting tomorrow. But we're set up pretty nicely here heading into next year. Uh, Certainly, you could get some profit taking perhaps going into 2024. But overall, there's nothing really nefarious out there that's scaring me. Definitely the growth forecasts are something that we'll be watching, and those elections as they unfold, they all bring their own risk. But right now, this bull market, while it might need a little time to breathe and consolidate, still remains in pretty good shape, Brett. So, what's your concluding thoughts here?
Yeah, I mean, I'm right with you. I think I want to see how this market consolidates and corrects, and to see how quickly that we start to see some balancing and evening out of sentiment data. That's always an important tell to me. So if we see, a few dip days, some sideways movements, some levels broken maybe on the downside here and there, do we see people start to immediately revert back? Because this has been the phenomenon, right? And I suspect we won't see exactly that, but we talked about this last time, that there's this phenomenon that we've seen where, for a while now, for 2 years or so, anytime there's a bad down day, people just get so dark immediately. And it's been a really interesting kind of telltale sign, a characteristic signal of this particular market for people to get so bearish so fast on the slightest hint of selling. It's just the end of the world's here. And it's been a really interesting thing. And we've had different theories about why that's the case. I'm really curious right now about whether or not that's still the case. I suspect it might not be. and I think that'd be an interesting shift to bear witness to. But I'd want to see to be really just continue to kind of gung ho bullish in everything. I'd want to see still a little bit of that, because that tells me, there's a lot more ammunition to people are really still have a lot more capital to throw into this market if they want to.
All right. Well, there you have it, Brett. I know you got to go get the kids from the school bus, or you get thrown in the pokey. So
That's pretty much it.
I don't want the man to lock you up there. So we'll let you get going. Hey, Brett, happy holidays to you. Have
You
a
do, Gav.
great rest of the year for you. Thanks so much for all the information you've provided us on this Sentiment and Flow show.
Hey,
This
we
has
had
been
a great year, Gav. I mean,
yeah,
we've been on the right side of things the whole way through, so it's
yeah,
good.
yeah. It was a solid performance by the show. I thought you in particular. So, well, I'll let you get going, Brett. For everybody else out there, we're just going to shut down shop here. I'm going to restart in a couple minutes. We will get the link to the slideshow and to the replay up shortly, and take a little look at the markets here as we squeeze up higher, and take a quick glance at Nike. So be back on in 2 minutes.
All right, take care, Gav.